There's always a ton to talk about when it comes to real estate, but there's not always a ton going on. We just learned that we have seen the lowest pending home sales in a long, long time. So what do you do when there's not a lot happening? We're going to talk about that today. And let's say hello to our friend Steve Olson. Hey, Steve.
I'm back.
It's good to have you back,
Thanks
man.
for having me. Yeah,
We've
good to be back.
been hanging around for quite a while, and it's awesome to see your trajectory. And what I wanted to talk about today is you've seen the slowdown. You know that folks are hesitant. And when we hear the big numbers on single family homes, we're talking about owner occupants. And that's different from what we do. We're, as real estate investors, we're looking for opportunity, which means we're paying attention to markets, we're paying attention to cash flows. Certainly things like the cost of insurance and the high rate of interest are on our mind. But I hear this news about this slowdown and think, okay, what does that mean to real estate investors? And is everybody sitting on their hands? What are you seeing out there?
I'm seeing exactly that. I heard a statistic last week that 75% of real estate agents didn't sell a property last year. I had a meeting with a big commercial brokerage where I live about 9 months ago. They had probably 20,000 square feet in this new Class A office building. We were trying to work on a couple distressed deals together. I saw them again 2 weeks ago. They had moved into a little executive suite in my office building. They're down to 900 square feet and 2 people.
Wow.
I mean, the transaction volume is anemic. That's what I'm seeing. But I can't help but think of that quote by Buffett, be greedy when others are fearful. I think there's plenty of nuance to that, of course. It doesn't mean just, check your brain at the door and start buying everything. But man, that is a lot easier said than done. When things are going great, you say, I'm a smart investor. I'm going to be greedy when others are fearful. Well, when things get fearful, that's gut check time. Whether that's right now, I don't know. But I tell you, the market is slow, but the investors are out there. The demand is out there. I've seen some rent softening, but I've not seen a collapse. I mean, people still need a place to live. They still need a place to rent. Yeah.
It's a great point that you bring up, though, is that when we see that, say, prices are going down, our sales have slowed, then everything in our fiber says, ooh, be careful, be on the defense. And yet I have a friend who says, why is it that Americans love to buy everything on sale except real estate? When real estate goes on sale, we figure, oh, better get out, right? Our friend Ken McElroy, boy, he and his partner Ross, between 2008 and 2011, bought $300 million worth of real estate, and they were often the only group at the table because everybody was playing defense, and they were smart enough to play offense. So I think that's the mentality. How can we think as investors to be proactive and on the offense when the world is hunkered down playing defense? So I know you've thought about this. You've got some strategies. You've been in the investor game a long, long time. What are some ideas there?
That's a great point, Robert. I had looked up a quote by Peter Lynch the other day because it feels like people are trying to time the market. It doesn't mean we shouldn't think about that. Yeah. But the quote from Peter was something to the effect of, there's 2 kinds of investors out there, those who know they cannot time the market and those who do not yet know they cannot time the market, right? And so I think you got to really narrow your focus and say, does this deal make sense? Does it make money? And get all that noise out of your head of, well, what if it goes up? What if it goes down? We don't know. I mean, we can have indicators, but those indicators are pointing a bunch of different directions right now, right? I could make a case to you for either way with the data that I see. So can you lock something in now that makes sense? And so we've been getting creative with our group as to how we can do this. And we've got 3 things we're working on right now. You want me to go into those? Was that your question?
I think let's talk about that because, theory is one thing, what we call head knowledge. Love that. You always want to be putting good ideas into your mind, paying attention to the broader picture economics. But seat knowledge is the thing that gets me through, right? Having been there, done that, have friends who have been there and done that, and seeing people that are actually doing stuff in the real world instead of just writing blogs about it. There's a huge distinction today between those that teach and those that do. And my favorite teachers are the people that do. They're not always necessarily the best teachers or even the most articulate at it, but when they're in the market doing it, we're blessed to have you in both of those chairs. You actually do this stuff and you can speak well about it, so I appreciate that. But take us through some of the things that you guys are doing in this environment.
Well, we operate in two different markets, Dallas, Fort Worth, and in Birmingham, Alabama. We own a general contractor, property manager, everything in both of those markets. And so I'll start over on the Dallas, Fort Worth side. We hear all the time mixed messages from investors who love the prospect of being in DFW. And then before they're even done saying that, they say, but man, those taxes, that insurance. I mean, Dallas insurance isn't as bad as Houston insurance, but it's bad.
It
Right.
is.
So how do you pair that up with the fact that it's going to pass Chicago as the third biggest metro in America in the next 5 to 10 years?
Right.
People just keep moving there in spite of the taxes and insurance. And can you square that up? And so one way we're working on that is we think a great asset class is what's called commercial flex space.
Yeah.
Some people call it industrial flex, but these are small little spaces with a roll up garage door. You just build out the shell and a little office and a bathroom, and local businesses move into these places. And there's a big shortage of this kind of inventory in a lot of submarkets. So we're working a deal in Weatherford right now, and we're doing this as triple net. So this is a way not to eliminate your tax and insurance risk, but to hedge it, to put that onto the tenant so you're not getting whipsawed every year with, well, now there was a hurricane and now insurance is X and Y. Instead, you can even out that risk because you're looking at a minimum of 3-year long leases here, right, where the tenants are responsible for all of those expenses. And so you can really, spread that out over time. So we're
Steve,
moving through.
No investor left behind. Let's just make sure we understand. I'm guessing most of the audience understands triple net, but in a residential rental situation, often the tenant will pay for things like electricity, but there are expenses that sometimes the landlord pays. I have an apartment building today that I've had for a long time that has master metering. It's not really master metering. Every 4 units has an electric meter. But because of that, I can't charge the tenants individually. So we have to have one rental rate that covers all of the electricity. And yes, just think about that, right? The one tenant is hardly there. They don't use very much. The other guy has the AC cranked on all the time, right? So when you look at a triple net commercial situation, it means that the tenant is responsible for a lot of the expenses that landlords would otherwise be responsible for. I use the example of like a 24-hour drugstore, one of the big brands on the corner that you go to. When they have something that goes wrong in that building, they don't own the building. If somebody else owns the building and they lease the building with a triple net lease, but when something goes wrong, they don't call the landlord to fix it. They just handle it. And to your point, when insurance goes up, they pay that. When property taxes go up, they pay that. So this is an excellent strategy to not be caught in a lot of the areas that investors are getting caught in today.
Absolutely. And, the way that we've structured it, I think this is pretty cool. I'm going to brag about it for a second because traditionally, if you want to invest in an asset like this, you've either got to be the developer or a limited partner, right? We've set these up where you've got a building of, say, 5 or 6 flex space units, and we condoized it. So you, as an individual investor, can buy 1, 2, 3. I've got a couple investors buying entire buildings, but now you control when you sell. You can do that if you're the developer, of course, but obviously being a developer, that's a whole thing, right?
Right.
But as a limited partner, you have no say. So you get to participate in the asset class and control it without being the developer. And that really opens it up to a whole new class of investor.
Wow, love that idea. In fact, you've been to our syndication event several times and seen me tell our story about office condos, and it's the same kind of idea. And what's great about this is many times the person that's going to eventually be your buyer could be your tenant. They start out, they don't know if the business is going to take, and it does, and it's successful. And at some point, you say to the tenant, you could own this building, and you show them how they can own it in a separate entity for all those reasons. But boy, that just gives you flexibility. And I will say, as a person who spends a lot of time in Texas, that you're exactly right. This kind of space is in huge demand, and there are so many businesses that need a space like this. The flex part of it people sometimes think, oh, that means that they have, different level of business in the summer than the winter. It's not that. It's that there are so many types of businesses that can run in this kind of a space. And sometimes more of it is office and less of it is shop. And sometimes it's just a little tiny office and a big, roll-up door. But having the ability to buy just one of those units, that sounds amazing.
Yeah, that's why it's called flex, right? You can have a gymnastics studio, a plumber, a bike shop. Because usually if you're going to buy something like this, like I said, you're the developer, but these spaces that people do build are gigantic. I mean,
Right.
We're talking under 2,000 square feet here for local small business. There's just not enough of that kind of space. So I think that's a great way to think out of the box and go on offense while the market is still finding its way here, because the market is fairly confused right now. But you look at this deal, you analyze the price per square foot, and you're going to make some positive cash flow on this thing. It's a great deal.
Well, let's talk about that before we move on to the next strategy, because financing is different in the commercial world. So is this a product that an investor can finance, and what might that look like?
Yeah, it's going to be a commercial loan, and we have a local bank that provides those. So anytime on a commercial loan, I do sometimes hear people misspeak and say, well, on a commercial loan, they don't care about you, they care about the property. Well, if you went bankrupt yesterday, they do care about you, right?
Yes.
But they're going to heavily underwrite that cash flow, the debt coverage ratio, all of that information. And as long as you've got a clean credit profile and can bring the needed equity, then typically, yeah, you're going to get this kind of a loan. And we've made it extra easy here because you don't close until it is rented with the tenant in place, which our management company handles. So
awesome.
That eliminates a lot of that uncertainty. You know what you're getting into by the time you close.
One thing I love about this, based on the size, and we haven't talked pricing, but I'll just make some assumptions, that this could be a great way to start diversifying your portfolio. Several of our shows in the last many weeks have been focusing on single family. There's a lot going on in the single family space. I know you've been in the single family space and small multifamily for a long time. But if I want exposure to commercial property, to your point, boy, I got to buy a big old thing. Not necessarily. Here you could get a little exposure in portfolio. And one of the great things about commercial property is you don't have the volatility in the rent. These tenants often enter into long-term leases, 3 years, 5 years, with options to continue.
That's correct. And I think you're right. It's a good springboard. I'm going through it right now where I'm crazy enough, Robert. I'm starting a HUD loan on a refinance of a 76 unit build for rent project. It's going to take forever. My broker tells me it's going to drive me crazy, but at the end, the turns will be worth it. But they look at a lot at resume. And because I've done a lot of smaller multifamily, even though that's not commercial, it's Fannie Mae conventional, there's a story to tell. There's a resume to build on, to talk to these underwriters with. And that's the same thing with commercial, doing little $250,000 flex space units. It builds a story. It builds a resume for somebody who maybe wants to go a little bit bigger in commercial one day.
You also eliminate a ton of drama. Not that small businesses don't have their issues, but, with individual tenants and apartments and houses and duplexes, I mean, they got stuff that comes up. This is why we love having property managers in between us and our tenants. But there's just less of that when it comes to commercial. And I love the fact that you guys vet the tenant, get the tenant in there, get it performing, now have verifiable income before someone takes over. That's awesome. All right, Let's move on to another offensive strategy.
Another one. So we're going to stay in the DFW metro. We've owned some land forever in Fort Worth, about 10 minutes from downtown. And interestingly enough, kind of in another phase of this company, we bought this land, started working on 10 duplexes, and we got red tagged by the city because there were no utilities on this street. It was lost on the city that, they never told us that, but there were no utilities. And so work stopped.
And most tenants, they appreciate having utilities.
They do. I think you can hang your hat on that one, Robert. So no utilities. We got red tag, had a few partially built duplexes we had to board up and kind of replan and reassess here. And we just got dumb lucky on this one, Robert. We learned we're in a federal opportunity zone. And whenever you're going ground up and, talk to your tax advisors, that's a primo opportunity for an opportunity zone because you typically have to buy an asset and then put improvements into the asset, at least in the amount of what you paid. And so when you go new construction duplex in an opportunity zone, that opens it up. So if you've got a gain of any kind, you can form your opportunity fund. You could buy a couple of duplexes in here and wash those gains out. Maybe not all of them, maybe all of them. We'll see what Trump does if he revamps this thing. But I think, to go on offense in a market like this, you've got to attack expenses. And taxes are all of our biggest expense, always. And this is one of the best ways I've seen to do that.
Yeah, it's fascinating. When the opportunity zones first came out and you go in the archives and hear when we talked about that, it was such an interesting and awesome idea. Whether you like or hate Trump, when you put a real estate guy in the White House, you're going to get some cool real estate stuff. And the idea is that in every single state, there are these physical jurisdictions, zones. You can't move the line. The line is where it is typically. But if you're in one of these areas, it does some awesome things for the folks that invest. And we've seen a lot of people decide to invest in an opportunity zone project, partially because it's a good project, but to a great degree because of the tax they can shield going in. You come out of an inflated asset, doesn't matter what that is. You can talk to your tax professional about this, but you can defer a bunch of the gain. And then what you make from the profit in the project has basically zero tax. So there's a lot there, more than we can unpack on the time we have together. But that's an exciting way to do it. I love that as an offensive strategy. The whole idea of opportunity zones was to encourage private capital, developers, investors to take care of some of these areas. And we're seeing, it's just because it's an opportunity zone doesn't mean it's an awful place you wouldn't want to be. There's demand there, and love that, especially, anything in the DFW Metroplex. If it's 10 minutes from Fort Worth, there will be demand from tenants in that space for sure.
Oh, yeah. We manage a lot of properties in that area, and they're always rented. The location is just too convenient. But I like what you said. I've done a number of deals in opportunity zones on, new construction fourplexes and such. And when you go into an opportunity zone, it's pretty common for you to say, I can see why they're trying to incentivize development here, right? But you can see it's like a mixed bag. This particular area is 7 minutes from the medical center. You go through the neighborhood and you see some houses that are just absolute dogs, okay? Yeah. But then you see other lots that have been scraped. They're going vertical with new construction. You can see that gradual revitalization. I've seen it in all the opportunity zone deals that I've done, where there's some properties where you go, I'm not too crazy that that's my neighbor or that that's down the street. But wow, I really like that I'm next to this brand new building right here. And it is having an effect. The tax benefit is so immense that people actively seek them out, and it is bringing redevelopment.
It seems like the world is playing defense. They're not sure what to do. And because interest rates are high and expenses are high, what most people do is nothing. But this may not be the best way to go. We're talking about how you can take some offensive strategies when the world's on defense. And we've got Steve Olson from The Peak with us. And Steve, you've taken us through a couple of really great examples. And I hope at the very least, people's minds are expanding. Like, it isn't just about what I buy a house for and what the interest rate is and whether or not it'll rent. There are so many other creative ways to get after stuff. So love that. Share one more with us, if you will.
I heard somebody explain it very simply once, that if your interest rate is higher than your cap rate, you're not going to like that deal. And that's a very common problem right now. And we've found a way to attack that. I know you don't want us to leave Dallas, Fort Worth, but we're gonna go over to Birmingham now. Yeah. And this is a popular strategy that most people know about. It's called the BRRRR model: buy, rehab, rent, refinance, repeat. And that's really tough in many markets, right? I would wish you luck in San Jose doing the BRRRR model, right? I just don't think it's going to happen. But there are many markets, especially in the southern U.S. and in some of the Texas markets, Midwest as well, where this is feasible. But you don't live there. You don't have the crews. You don't have the management. So we call it our concierge BRRRR model. Somebody who understands this process, is willing to accept that, yes, it does have some risks, but I want to get a little bit more aggressive. So, we go out through our wholesale operation in Birmingham. There are a couple of zip codes that this works really well in. I think you probably kind of like a B-class neighborhood, maybe even a high C, where this might work. You have to have a market where you can get appraisals. It can't be one that is so dilapidated that nothing is getting a good appraisal. But it can't be such a good market that nobody has a distressed property. Oftentimes, these are properties that are 30 years old or more. Somebody owns them. It's an estate situation. It's a complex legal situation, right? These things come with hair on them, but you can buy them at a deep discount, renovate them, and refinance. And really, I may be oversimplifying it, Robert, but this is a rental home that you're ultimately in at for maybe 10% down when it's all said and done because you bought it at such a deep discount. And whenever you're doing that, you've got better cash on cash returns because your cash flow is the same as if you would have bought a fully renovated house. But you understood the process. It takes, 90 to 120 days front to back to do a BRRRR deal, but you just plug it into our system. We find it, our crews renovate it, we help you refi it. We even provide the hard money for this deal out of our debt fund. So that's why we call it the concierge BRRRR model.
Well, let's break this down a little bit because this is another really good way to think differently. What a lot of folks do who are either turnkey providers or just folks that flip houses, they find the house, they fix it up, they do the work, it takes whatever time it does, they have whatever capital they need, and now the person who buys it gets what we call the fat cow, right? They didn't buy the skinny cow that needed to be fattened up, they bought the fat cow, and for a lot of investors, that works great. The challenge is, right now, you're paying top dollar for that. The expenses are back to being high. Your basis is higher, which could serve you in the long run, but it does mean that your cap rate is maybe not in the right position as your interest rate, as you talked about. So what's happening here is you're going through that same process, but you bring the investor in at the very beginning at the lower price.
That's exactly right. And people always want to know, well, what's in it for you? Right. When you're a construction company or you're selling homes, you make a margin on what you sell.
Sure.
We make a very small one in this type of model, but because it does run through our debt fund, because we do end up with the property management, we've got a few different profit centers to where, hey, this is worth it. We especially like if an investor can come in with, 100 or 200K, because we can turn that into, 10 houses or more for this investor. You can come in with less than that to the program, but it's a cool strategy that we thought of, and we've got deals in the pipe right now that we're working. And if you've got a little bit less capital to work with as opposed to fourplexes or duplexes, it's a great way to maximize that leverage, but still being in an area that has good conservative growth. You look at Birmingham. I've seen the studies. We had our financial modeler pull it all the way pre-great financial crisis, and there's a while where the market just kind of trudged along, didn't really do much, even dipped a little, but not much. And then it's just kind of gone up a healthy amount ever since then. So I think that it's a good market because when you're going through a renovation and your property's not performing yet, it's risky to be in a market that loves to spike and dip and everything. And Birmingham doesn't really do that. The chances that deal is a lot different for the bad by the time you're done renovating are not likely. I won't say they're impossible. We've seen some weird times lately, but if history is any kind of a guide, you're going to really like that equity position that you're in.
Yeah, I love the stableness of that market. It isn't exciting, huge uprun, but it doesn't go the other way either. It's just kind of slow and steady wins the race. But it is a unique positioning you're taking here, because if folks wanted to do this themselves, they're probably not going to get a bank loan on a property that needs this much work. So they're able to either bring in cash or through your debt fund, a short-term loan to acquire the property, get the work done, and so forth. Now you've got a beautifully rehabbed property, and you can get, I'm guessing, a traditional loan on the property at that point. That's the refinance part of the BRRRR model.
That's the whole idea. And this isn't rocket science. Anyone can do this. You just need to be able to source properties on a wholesale basis. You need to have access to private capital and construction crews and management. And somebody who wants to do that badly enough could certainly develop that system. If you can't, or you don't want to, or you don't have the time to, you should give us a call and we'll do it for you.
Absolutely. And I love that you're doing the property management piece even on the flex space, because that is one of the big headaches and one of the costs. A great property manager pays for themselves easily. I feel that the property manager is often the least respected and most important part of the team. But as you know, you do need the right construction crews and managing that and figuring out materials and logistics. And it's just a ton. Not that you can't do it on your own. You absolutely can. But for a lot of folks that listen, they're like, I get the investment. I see how that makes sense. I'll just have you guys do the work and I'll be the beneficiary of that. Hey, we didn't get to talk a whole lot about the drivers in the marketplace today, but Steve's put together a couple of awesome reports on these two metros, on Birmingham and on DFW. Before we're done, I'll tell you how you can get your hands on those reports. Very informational. It'll also give you Steve's contact information in case you want to pursue any of these initiatives. And I'm going to guess there's going to be more because you guys are out there looking for opportunity, and it's great to have the team in the marketplace that you control. It just removes another variable. So good stuff. Steve, closing thoughts.
Well, I like your thoughts on property management. If your real estate team was a football team, the property manager's the kicker. You don't really notice him until he doesn't do his job. So you've got to have a good one. But I think it's just, if you can lock in really good cash flow today, I've been saying this for a while. If you can lock in that cash flow and interest rates in 5 years are what they are today, I think you're happy you did that deal. If interest rates go up, you're really happy you did that deal. If they go down, refinance, right? I think that's the way you time the market, right? It is through taking advantage of those financing opportunities when they are given to you. The trick is finding the deal that does generate you a return right now. That's hard to do, but I'm hoping we presented some options that people can take advantage of there.
It's also hard to find time in your busy schedule to listen to podcasts, to go to events, to get educated. But the folks that have made it this far, well, they're doing exactly that. So you're on the right track, and don't be discouraged. There is opportunity everywhere if you just stay at it. Steve, always good to connect with you, and appreciate your out-of-the-box thinking today.
Yeah, thank you, sir. Good to see you.